Thank you all for taking the time to join us this afternoon. My name is Harris Baltch. I run the investment banking team here at Dynasty, and I'm privileged to have a very special guest with us today, Andrew Marsh, who's Dynasty's executive in residence. Andrew, thank you for being here with me today.
Thank you. Glad to be here. Hi, everybody.
And for those of you not familiar with Andrew, Andrew was the former CEO of Richardson Wealth, which is a Toronto Stock Exchange listed RIA based in Canada with an enterprise value of $350 million. And it's one of Canada's largest wealth management firms with about $36 billion of AUA, $350 million of revenue, $62 million of adjusted EBITDA, and nearly 160 advisors, and serves over 30,000 households. Andrew, thank you for joining us today. Tell us a little bit about yourself.
Well, I'm Canadian. We led with that. I've been in the wealth management business for 30 years. I grew up on a very a small town area in a family farm. Always was interested in financial markets. Started my career as an investment advisor myself, and got an opportunity to start my own firm with a great team of people, and have had a great run and happy to be here.
Thank you. You're being bashful. I mean, there's so much to talk about yourself and your background. I mean, you ran Richardson Wealth as the CEO from 2010 to 2021, but you founded the business in 2004 with virtually nothing. Mm-hmm. So what made you decide to go into wealth management altogether?
Well, wealth management was a attractive industry for me because I found that it was the perfect mix of being involved with financial markets and also helping people, being able to be an entrepreneur and build my own business, but also have a positive impact on the lives of my clients. So to me, I've just always loved the industry. I've loved the challenge it brings. I love the people that I've met along the way. But in 2004, actually prior to 2004, I got to the point in my career as an advisor where working for one of the Canadian big banks, same thing that's happened in the U.S., I really saw the bankification of how we operated, and I looked back to the early part of my career where I actually started as an analyst covering bank stocks. And that was shortly after the Canadian banks bought up every independent brokerage house in Canada. And so all of these things kind of culminated where I thought, boy, the banks are really screwing up wealth management, in my opinion, and there isn't an independent equity ownership alternative for people like me. Thinking back to the days where these private partnerships existed before the banks bought them out. And so 1 and 1 equaled 2, and I started thinking about how great it would be to find other like-minded individuals like myself that wanted a we culture instead of an us versus them, wanted to build something that represented where the wealth management industry was going, not where it had been, and obviously to offer an equity ownership stake to people that wanted to be partners.
Wow. I mean, you were well before your time in terms of thinking through that. I mean, what was the reaction? I mean, jumping from a place of familiarity where you had technology, but also potentially bureaucracy into launching your own business. How did that feel at the time? And what was the reception when you started the firm?
I was absolutely nuts to do it. No, it was a massive risk. It was a massive personal risk, but I just had this belief, again, I felt like as my practice as an advisor grew at a bank, I felt less and less like an entrepreneur. I'm also someone that isn't comfortable in a comfort zone. And I'd kind of built up enough scale of my practice as an advisor and a great lifestyle with my family. And I just thought, at that point I was 35 years old, and I thought, this can't be it for the rest of my life. I've got to do something that is more entrepreneurial, that changes the game. And so when we launched what was then GMP Private Client, because the Canadian landscape is so dominated by banks,
right,
we had so many skeptics saying that we couldn't make it. And so it was, one of my favorite things is from when I was a kid is I love being underestimated. So I believed in what we were doing. I believed in the people that I was partnered with. And I thought we were at the right moment in time to capture the attention of people who might have been thinking along the same lines.
That's great. I mean, so take us through that journey with a little bit more detail, and I'd like to take a couple of pit stops along the way and touch upon one of my favorite topics, M&A, because your journey was fairly involved with M&A along the way, whether it was merging GMP Private and Richardson back in 2010. You had the 2013 acquisition of McCrory's private banking business. But then you also had a divestiture in 2014 where you sold some assets to Dundee Wealth.
Yeah.
And then you ultimately had a reverse takeover of GMP Capital, followed by the IPO. So can you take us through that journey a little bit, and we could touch on any deal that you'd like, and maybe talk about some of the rationale and structuring
Sure.
goals when you were going through the process?
Sure. Like Mike Tyson says, everybody has a plan until you get punched in the mouth. We had a great plan when we launched in 2005, and it didn't involve M&A at all.
Sure.
Obviously, it's on the horizon, but you don't build it into your plan. Our plan was just to find like-minded people and recruit them. I think the language the RIA in the U.S. uses is tuck-ins.
Right.
We call them recruits.
Sure.
And so we literally started with zero, like you said. And I laugh and say that I was the national sales manager of no sales or salespeople when we launched. But our story resonated. In pre-2008, which was really the punch in the mouth, from 2005 to 2008, our story resonated so well, we recruited 44 advisors and $5 billion in assets.
Wow.
And set up 4 offices across Canada: Montreal, Toronto, Calgary, and Vancouver.
And that was all during the financial crisis?
Just before it.
Just before.
So that's why I say, like, we were kicking ass right up until the financial crisis. Then we got punched in the mouth.
Right.
And so I think
You and
that's when
everybody
all
else.
these M&A opportunities started to line up. The first one was a merger with one of our competitors. So I was partnered with I'm sorry, I hit my mic there, a publicly traded capital markets dealer, which was GMP Capital. And what we were really building was to build an ultra high net worth division that took all the entrepreneurs that GMP was taking public and helping them manage and navigate their wealth. We were competing with a firm called Richardson Partners, which was owned by one of the wealthiest families in Canada. Going after the same type of advisors, going head to head in most markets. And so when the crisis hit in 2008, we were at $5 billion, they were at $7 billion. And we kind of called each other up and said, we don't know what's on the other side of this, but scale really matters. And so that's what led to our merger.
Were you getting pitched by bankers to do that all along the way, or was this something that was more organic? You kind of knew the competitive landscape of independent wealth managers in Canada, and you thought it was the right call to make. But what kind of surfaced to make that call happen?
Well, I think there was, so the thing I love about the U.S. market versus the Canadian market is that there was really only 3 independents. There was us, there was Richardson, there was a company called Blackmont that was the company that ended up selling to McCrory. And so we were actually pitched by Blackmont first to merge, and we looked at their business and did not like it at all. And then this conversation with Richardson started up, and that was a great fit in terms of our geographic landscape. They had a stronger office in Montreal than we did. We had a stronger office in Calgary than they did. So it was a really good mix. And on paper, and the rest of this story will play out later in our discussion, on paper, the merger of one of Canada's best, most dynamic capital markets dealers and one of Canada's richest families was just great on paper. So the merged company ended up being about a third of the company owned by myself and employees, a third by the Richardsons, and third by GMP. During the merger, that was my first merger experience. That was an interesting experience because it was very acrimonious between the two parties. I was named national sales manager of the merged entity, and the two parties thought they were protecting each other's interests by naming our CEO and their CEO as co-CEOs. And I know everybody listening in has seen that movie before. It did not end well. Morale was horrible, leadership was horrible, decisions weren't being made, and about 4 months into the merger, they fired both CEOs and named me the CEO.
Wow.
So that was April of 2010.
Wow. So 7 plus 5 equals 12. 1 plus 1, was it 2? Was it 3? Hard to say, but ultimately, you have so many stakeholders, especially after you do a merger like that. But certainly a lot of lessons learned, I'm sure, after that deal was done. So you kind of went back to putting your head down and executing as CEO. until 2013 rolled around, where you had the opportunity to acquire McCrory's private
Yeah.
bank. How did that come about?
So yeah, so after we merged and I became CEO, the merged entity was about 10.6 billion because of the market meltdown and a few departures.
Right.
Every time there's a merger, or at least every time we did a merger, there was a few people that kind of shook loose. So from 2010 to 2013, we were able to kind of build our new brand and go back to recruiting. And we ended up being able to grow from 10 billion to 16 billion in those 3 years. At that point, we were competing with McCrory because McCrory had come in and bought Blackmont, and they brought in a very aggressive approach, very heavy, like they were almost offering twice as much in recruiting checks as we were. So they were gathering a lot of assets, but spending so much money, we just knew they weren't going to last long. And so sure enough, in 2013, we got a call from Australia saying, we think that scale in this business is 25 billion. And we were at 16 billion, they were at 12 billion. And we said, yeah, we're at 16 billion, so we're cash flow positive and quite profitable, but 25 billion is where the magic is. And so the Australian guy said, we're never gonna make it to 25 billion the way we're spending money. So would you guys be interested in buying us? And they specifically sought us out because our brand was really good. Also, they knew that their advisors were independent and wouldn't respond well to a sale to a Canadian bank.
Sure.
And so we were good partners.
Did you use an investment banker on that deal?
Yeah, because one of my ownership groups was an investment bank, we had in-house capability
Wow.
and advice. But so it was great because we had our executive team as well as the investment banking team working together. We wouldn't have been able to do it without the investment bankers because they were so good at navigating the valuation discussions, navigating the identification of risks, how to value those risks. So it was a great partnership, getting the work done required to create the model, to create the interest and the ability to make the acquisition.
So what was the market perception after you went out with the announced deal?
People were shocked, and mostly because the Australian guy that came to Canada to run McCrory was a loudmouth guy who loved to use the press to talk about how great they were doing and how badly we were doing. And so everybody had the perception that we were not doing well, but they were doing great. And so when the tables turned, it's actually one of my favorite moments because there was one reporter in Toronto that loved this guy and published everything this guy said about us. And so my favorite moment was when we announced our acquisition of them, and this reporter had to call me, and he was just speechless. He didn't even know what question to start with. So that was just one of my favorite moments that I just let that guy sit in his issues.
So did you find real synergies from an
Yeah.
acquisition like that? Can you comment on some of the synergies that you
Yep.
may have benefited from as it related to maybe scale synergies, potentially revenue synergies, potentially some cost synergies as it relates to the
For sure.
duplication of services?
We learned to target synergies in areas like, and this comes back to our merger as well as the acquisition of McCrory. Synergies came from being able to renegotiate third-party contracts. All of a sudden when you go from 12 billion to 26 billion, you're a much bigger player and you can negotiate better prices. So we had a great list of all our third-party vendors that we were able to renegotiate with. Because each of our merged and acquired companies were also cross-Canada companies, we were able to merge offices and save significant amount in office real estate costs. And the head off, because we were, unlike an RIA in the US, we were also owned our self-clearing. So we owned our back office, we owned our custody.
Wow.
So we had back office people as well as front office people. And so we were able to, let's call it staffing synergies.
Sure.
Because when you merge or acquire, you've got two people in every job and you have an opportunity to upgrade and top grade your talent and save money. So between real estate synergies, third-party vendor synergies, and staffing synergies, we were able to execute those deals very well.
That's great. I mean, in terms of the deal itself, to the extent you're comfortable commenting, I know we have a lot of folks on the line. Can you comment on how you approach the deal structure?
Yeah, so for the merger, the reason it became acrimonious is the Richardsons had just done a recapitalization at a really extremely high valuation because they didn't want to dilute those that weren't able to recapitalize. And we were proposing a valuation respectively that was about half of what they'd just done their recap at. So they needed to save face. And so for the Richardson merger, it was a straight up share swap at respective valuations. McCrory was different because McCrory wanted to pull out of Canada and get out fast and clean. We were able to take advantage of that and say, you know, if you want all risk to pass, it's going to drop the price this much. If you want us to take on all your excess office space, it's going to drop the price that much. So we started with a straight up valuation where we were going to buy them for $220 million. And because we convinced them of all the things that were going to reduce the price, we ended up buying it for $130 million.
Wow.
And the best part of it, which is going to be your next question, I know, is the interesting thing about McCrory is they had $12 billion in assets. And we had a very disciplined model in terms of the type of advisor and the type of practice that we wanted. And McCrory had $10 billion in assets with 100 advisors and $2 billion in assets with another 100 advisors. So we were very clear that the 100 advisors that were sort of old school stockbrokers did not fit our model. So we convinced the Australian guys that we didn't want them and that we were going to sever them, and that the severance cost was going to be $16 million. That came off, sorry, $26 million. That came off the purchase price. And then what we did as soon as we closed on the deal is that I knew of a smaller firm in Canada that was looking to grow. So we sold those 100 advisors and $2 billion to that firm, Dundee Private Wealth, for $16 million. So instead of so we got the reduction in the sale price of $26 million. Instead, we got paid $16 million for that asset.
Wow.
And again, my favorite part was the Australian guy that we were negotiating the deal with sent me a brief text saying, "Well done, sir."
Well, it was great that you were able to pre-wire effectively a second deal while you were still in the process of closing.
That was
your
not
first.
easy.
Yeah.
It was not easy, partly because on the human nature or the humanity side is the people that we wanted, we were actively showing love to and trying to retain. The people that we knew were on the list of people that was going to be sold, we kind of ignored them. And that made them very, very uneasy. And so it was a very difficult thing as a human being to navigate.
How did you manage the emotions of the advisors during this time? Because, you know, you have basically an unsecured asset, which are the people that walk in and out of the office every day, the holy grail of the relationship between the advisor and the client, you know, and you know, over a 3-year period, you know, you're merging two businesses, acquiring another. How do you manage the emotions of all the advisors so that they feel good about the way you're approaching the growth of your business?
Man, it was hard. And so it's a great segue because one thing I wanted to say in this session was, you know, I don't want to be this guy that sits here and says, we did this, we did this, we did this. It wasn't without massive amounts of stress and massive amount of personal sacrifice. But the answer really is, that was really, from the merger of Richardson and GMP to the acquisition of McCrory, that's really where I learned to be a good leader. And, you know, my leadership style was always is always extremely transparent. And I found the best way forward was just to be honest with people, transparent with people, and to paint a picture of where the business was going. And it didn't resonate with everybody. I wasn't everybody's cup of tea.
Right.
I didn't like everybody. But for the most part, the people that stuck around and at least gave us a chance were people that identified with my communication style, my level of authenticity of just wanting to win and wanting people to be on the bus with me. And so I guess the short answer is, that's where I really learned how to be a good leader. And I think as your business grows from how small it was when we started, it's relatively easy to be a good leader when you're national sales manager of no sales or salespeople. But the test and my personal growth and evolution as a leader was through that period.
So it's 2014 now, and you know, post the divestiture of $2 billion going over to Dundee, you're at what, in the mid 20s?
$28 billion at that point.
$28 billion, and then you did the reverse takeover of GMP Capital in 2020. Can you comment on that transaction?
Yeah, for me, that's the sad part of the story, because my preference would be that I would still be there, that we stayed private, that we worked together well as partners. Because when we finished 2014 and heading into 2015, we had an amazing firm and we had everything set to take everything to the next level. The challenge was the Richardson family had different expectations of what they wanted from their investment. Because the biggest challenge was my friends at GMP Capital were a mid-cap, small-cap investment banking firm they were the firm that brought Research in Motion public and companies like that back in the heyday. Mm-hmm. And the problem with the Canadian capital markets through this period was this is where the small cap, mid cap funds disappeared in favor of passive ETFs. Mm-hmm. So the entrepreneurial spirit in Canada made public capital markets very, very difficult. So while we tripled in size as the wealth management firm, GMP Capital made misstep after misstep trying to expand in a world that was rapidly changing for Canadian capital markets players. So their value went down this way and our value went up this way. And it created a dysfunction amongst our ownership group, which was very difficult for me trying to navigate it. Richardson's had a negative attitude towards GMP. GMP wanted money because they wanted to shore up their balance sheet. Mm-hmm. And so it created a bit of a, instead of all for one, one for all, which is what my preference would have been, and we would have just invested in the business and grown, it created everyone in their own corner with their self-interested agenda. And because we had a shareholders agreement that specified how either party could take over the private wealth business that I built, the only path forward to liquidity and to solving our issues was to sell the securities dealer to Stifel. Mm-hmm. So Stifel came up to Canada and bought GMP Securities. That left a publicly traded holdco called GMP Capital that had $160 million in cash and a third of us. And so our path to liquidity was not to go public and go through all of that risk, was to take our asset and do the reverse takeover of the public company, which created a publicly traded holdco and 100% ownership of Richardson Wealth.
Wow.
So it was complicated and also extremely stressful, and from a personal perspective, very frustrating because I love building businesses, and I was in a phase of shackled and not being able to build the business, and instead navigating, the self-interested agenda of my shareholders.
So as a publicly traded company, the value proposition to employees, to advisors, is very different.
Yeah.
The way you manage a business is very different.
Yeah.
In the light of public shareholders having exposure to all different types of publicly traded company risk, as opposed to being private. How did you kind of articulate the value proposition, particularly to advisors, when you were trying to talk about the value proposition in the context of having advisors being attracted to your platform, and why they wanted to be there, and why ultimately Richardson was a destination of choice, both before and after you went public?
Yeah, that kind of evolved over the years. When we started out, it was the people we attracted were people that wanted to be equity owners, and so they were focusing on the financial benefit of being an equity owner. And going public created that wealth event for them. Mm-hmm.
Were advisors able to participate in wealth creation?
That was our recruiting offer. Our tuck-in offer was part cash and part equity.
Part equity.
Which was great culturally because it eliminated anybody that was just looking for a check. Mm-hmm. So culturally, we were able to eliminate those people and attract the people that had the same mentality that we did. So, and that's a good segue because we realized there was 3 reasons why we were better than everybody, or why people stayed with the firm. One was financial reasons. One was our culture. And the third one was our platform and our technology. And so we felt that if we could check all 3 of those buckets, we were good in terms of maintaining long-term relationships with our advisors. So going public, it changes that financial bucket a little bit. But by that point, the brand of Richardson Wealth has grown so strong in Canada because of its high quality and disciplined approach to how we do business. The cultural and tech platform is still leading edge in Canada. So even if advisors get frustrated or think about leaving, We just were always confident that they couldn't find a better place to work for all those reasons.
Mm-hmm. So in the beginning of 2021, you ultimately stepped down as the CEO of Richardson Wealth. And about 2 years later, we had the benefit of finding you and having you join Dynasty as our executive in residence. What made you choose Dynasty? I mean, you've worked in this industry for such a long time. I imagine over the past 2 years while on the beach, you've got called up for a variety of really interesting opportunities. And instead you decide to commute down here to sunny St. Pete every couple of weeks from Toronto to be part of our team. Can you comment on what made you make that decision?
Sure. I needed my 2 years. I'll say that because the last transaction I did that took Richardson Wealth public, it felt like that was my culmination of fulfilling all the promises I've made to everybody that I partnered with along the way, whether it was my executive team, whether it was the advisors, shareholders, friends. And so I felt like, okay, we've delivered on that. I was exhausted at that point. And frankly, I wasn't having as much fun reporting to a public company board of directors as I was when we were first building the business. I'm an entrepreneur first and a business builder first. I'm not a public company CEO, I don't think, or at least I wasn't of that particular public company. So I needed time to kind of recalibrate, and which was just the great. I recommend it to everybody listening in, by the way. If you can take 2 years off and rethink your life and be introspective to think about the things that you loved and also the things that you don't ever need to do again. So I was really, really fortunate to have that time. What I realized in that time was I still really love the wealth management business. I love building a business. I love helping people build their business. I really like the people that are attracted to the wealth management business. And so as I looked at what I wanted to do next, frankly, there just wasn't a lot of opportunities in Canada that were appealing to me in the sense of there wasn't anything new to do. Mm-hmm. And so Cheryl and I go way back. Richardson Wealth was a Canadian solution for Dynasty over the last 10 years. If any of Dynasty's RIA network clients needed a Canadian solution, my firm was that solution. So Cheryl and I became friends over the years. Mm-hmm. And so, of course, as I started to think about getting back in the business, I spent a lot of time calling my friends and calling my network of people in the wealth management industry just to kind of talk things through. And the shortest version of the answer to your story is I love this Dynasty opportunity for me. As I said, I'm not a comfort zone guy, and Canada has kind of become my comfort zone. Mm-hmm. I love the fact that I can learn so much about the RIA business in the U.S., and I'm learning a ton in my short time here. Dynasty itself, I think, is just a fantastic firm that's aligned with my sensibilities around being independent and entrepreneurial, and I can surround myself with independent and entrepreneurial people, both at Dynasty as well as their network of clients. So so far so good.
Well, we're really excited to have you, and look, I think we have a lot of CEOs and advisor owners on the line. If you have any questions on the Zoom line, you're welcome to ask a couple of questions. I think at the bottom of the screen there's a prompt for Q&A, but maybe just to get going, any advice for listeners on the line with respect to looking out for some of the key inflection points for growth and how to manage them? I know that as you went from 0 to 30, you commented a little bit on some of the M&A deals and how those were clearly key inflection points in your growth trajectory. But you've had the opportunity to meet with some of our clients at Dynasty who are growing their firms in their own way, and they're hitting their own inflection points and challenges. So any comments that you have for viewers on the line right now?
Yeah, I think I think the way I would answer the question is thinking back on the things that, all the recruiting that we were able to successfully do, all the transactions we were able to successfully do, all the ones that we tried to do that aren't on your list here, that didn't happen. The most important thing that I'm most proud of is how disciplined we were. We worked hard at reminding ourselves who we are, what we stood for, what we wanted to achieve, and we were very, very disciplined in that. So we were comfortable saying no to people. There was a stretch of time where I probably said no thanks to about 10 recruits that just didn't fit our culture. They were looking for different things that we could offer, and we were very disciplined in saying no. We had a couple of transactions that came our way that we could have executed on that we turned away because they weren't a good fit. So we didn't do deals for the sake of doing deals. Mm-hmm. And I think that's a really important piece of advice. I think in the RIA network, and you see this, Harris, is that people are thinking about M&A, should I be doing it? How do I do it? And the best answer is just be very clear on who you are, what you stand for, and what you want to look at in the mirror, mm-hmm. And don't lose sight of that.
So if you're an RIA owner or a CEO thinking about doing M&A and you have a pipeline of deals, or maybe if you're ready to start executing on a deal, any advice that you have for that CEO or listener on the line?
Well, I do think you need to work with experts. I was lucky enough to have a partnership and an ownership group that included a lot of really smart investment bankers, and they were indispensable in helping me navigate. Like, I knew my business and I knew what our leverage points were, but the help that we got on identifying risks, valuing those risks, and negotiating points, I guess is what I'd say, was the difference maker. What I learned was the most important thing is to have the right people in the room with you, giving you advice that was objective, mm-hmm. not self-serving, and then prepare yourself for that post-transaction execution. I like to laugh, when the investment bankers leave the room.
That's when the real work
you're
starts.
on your own.
And maybe just one final question as we're wrapping up this afternoon. What's the most important piece of advice you have for an advisor that's debating whether or not to go independent?
That's a great question. I think if I was talking to that person sitting in your chair, I would ask questions around what your motivation is. As much as I say it's things that I'm proud of, one of the things that I wish I'd done a better job of with my ownership dysfunction was to be more clear on what everybody's ideal outcome is. And that's where we got kind of misaligned, mm-hmm. because what GMP's ideal outcome differed from Richardson's, which differed from mine, and that created that dysfunction. And so I think if that person was sitting in front of me asking me, what advice do you have about going independent, I think I would just have about 10 questions around what's motivating you to do so, and what do you think you're going to see on the other side? What do you think you're going to achieve with that? And I think you'd want to answer the questions in ways that are about more than just, I want to increase my payout by 4 percentage points. I think it's got to be more than that. I think you want to be entrepreneurial mindset. You want to be an owner. You want to build an enterprise, not just a practice. So those are the kind of questions that I would ask. Whoever asked me that question, I'd be happy if you looked me up and I could have a phone call or a beer with you.
Thanks. Maybe just one last question. I know we have a little bit more time, but for some of our core clients that are on the line right now, if they wanted to speak with you or meet with you, what's the best way to get in touch with you, Andrew?
amarsh@dynastyfp.com.
Or you can email me.
We should flash it below the screen right now, like an infomercial.
Well, look, I'd just like to thank everybody for taking their time this afternoon to speak with me. Andrew, it's a privilege to have you on the team.
Thank you.
Thanks for joining me this afternoon. On behalf of everyone at Dynasty, my name's Harris Baltch. Thank you for joining us this afternoon, and we'll see you next time. Thanks,
everybody.